Thank you everyone for joining us today. We will be covering how to utilize your self-directed IRA or retirement plan to invest in trusts or LLCs, commonly referred to as checkbook control. My name is Alex Perney. I will be your moderator today. I've been with Advanta for about to finish up my 5th year. I'm a member of the American Banking Association and also hold my designation as a certified IRA services professional as well. I am seeing some questions roll in, so please do get those in there. Just type them into the chat box as everyone's microphone is muted. I will answer them throughout the presentation. I'll get to the first round of questions here in a moment after we do the brief introduction. So a few key points I want everyone to take away from today are what kind of accounts you can self-direct, whether that is checkbook control with a checkbook, LLC, or trust or not, the difference between us handling your investments as the IRA administrator versus utilizing checkbook control with a trust or LLC, and the inherent advantages and disadvantages of utilizing these types of assets underneath of your IRA. Bit of a breakdown of how we're going to structure the presentation today. I'm going to give you a brief overview of who we are at Advanta IRA, what a self-directed IRA is, the types of assets and accounts that can be held underneath of IRAs, not just with the LLCs or trusts, but keep in mind that the assets we'll cover can be certainly held in the checkbook control trust or LLCs, what exactly the checkbook control IRA is, and how to get started with this type of investment. We at Advanta are a self-directed administrator that serves clients nationwide. We provide you with the platform to make the single decisions on exactly how you want to direct your retirement finance without having a prescribed list or restrictions on what exactly you can and can't do, so long as it falls underneath of the regulations of the IRS and being able to accomplish that type of investment. We have over 20 years in the industry of administering self-directed IRA accounts. We currently maintain over $700 million of clients' assets underneath of their IRAs and 401ks that we administer directly here. And keep in mind that it is all self-directed investments. And we offer a dedicated account management program. So it doesn't matter if you are a small client or a big client, every single person gets dedicated account representation. So you don't have to worry about calling into a call center and getting a different person each time. You get to build a relationship with the singular point of contact here at Advanta. Although we do maintain 2 regional offices in the Southeast, we have done investments throughout the United States and across the globe. We maintain our main back office here in sunny Largo, Florida, and our regional office in Atlanta, Georgia is there as well. So inherently with IRAs and the fact that you can do alternative type investments with them is the need for a lot of education. We try to promote and provide the best education possible to our clients and potential people that are looking to educate themselves on self-directed IRAs. We maintain a full suite of products that you can use free of charge to help educate yourself. By inherently the fact that you are signed on today, you are attending one of our events. We don't just do webinars, we also do lunch and learns and networking events around our regional offices that go over the exact construct and ways to utilize self-direction. We have an on-demand program, so just like you would with a point and click for any type of education that's already hosted online, we host all of our audio recordings along with the slides for today will be put on our YouTube channel, as well as other private events that we do. We will also put on there, if available, for slides and recording to our YouTube channel. So if you can't make it today or you have to sign off early, do understand that this will be put up in its entirety onto our Advanta YouTube channel. And we maintain a up-to-date blog with all of the latest and greatest from the IRA perspective of industry trends and what is happening in the world with regards to IRAs in general. So what is a self-directed IRA? Most people haven't heard of self-directed IRAs inherently because they're not promoted by large companies, and they only make up about 4% of the total investments in the roughly $27 trillion of retirement assets in the United States currently. The large investment banks and brokerage houses don't have a vested interest in promoting these types of investments to clients because they can't make money off of them. They can't sell you a piece of real estate in your IRA, and they can't administer that type of asset. So it opens up the door for a company like Advanta to help you realize the potential in doing real estate or private LLCs and trusts underneath of these types of accounts so that you can get great tax-deferred or tax-free benefits from doing that type of investment. So a self-directed IRA is simply just a term for how you invest the IRA. The IRA and its DNA is the same no matter where you hold it. So the IRA you have at Advanta is the exact same type of account and exact same qualifications as one you might have at Fidelity or Charles Schwab. The difference is that we offer the platform for you to choose the type of investment that you want and to take that full control and being able to select how your money is invested and what type of returns you'd like to have. Now, there is inherently some questions about how you move money between these types of accounts, because the great thing about having money in one of them is that you're not paying taxes on it. So in order to maintain that tax qualification of your money, there's a few key terms to understand when it comes to moving money between like type of accounts. If you have the exact same type of account at one company and at another, you can do a custodial transfer. This is where the receiving custodian pulls the money over from the other custodian in a non-reportable, non-taxable movement of money. You can do as many transfers in a year as you'd like. There's no restriction and no reporting done. It is certainly the most preferred method if you can do it, as it is the simplest and you have the least reporting to do and nothing to really keep track of at the end of the year for you as the client with regards to filing your taxes. The second method is what you use when moving from one type of tax-qualified account to a different type of account. Namely, people will see this when they're moving from an old employer's 401k into an IRA. They are directly portable to each other, so you can move from a 401k to an IRA with no tax and penalty consequences, or maybe you had a nonprofit 403b, a governmental 457. If you were in the armed forces, you probably had a thrift savings plan account, pensions from large pooled unionized labor, and the like can all be directly ported into an IRA without tax or consequences. However, you have to do it via a direct rollover. This is a type of distribution that is going from your 401k or old employee's plan into your IRA. There is reporting done on this, so just keep in mind that if you do have to do this type of movement, that there is some additional reporting and documents for you as the client to keep track of, but again, non-taxable and non-reportable. So, types of assets and accounts. On the screen that you'll see are the different types of accounts that we primarily handle here at Advanta. Now, again, to one of the key points is that what type of accounts can be self-directed and what type of accounts can be utilized for checkbook control. Every single one of the ones on this list can be self-directed with a checkbook control LLC or trust. Now, the main differences between these plans aren't so much in the structure of how you invest things or anything like that. The primary differences are all going to be based on how you add money into the plan and also the tax ramifications of taking money out of the plan in retirement. The two most common plans that people associate with IRA investing are the traditional IRA and the Roth IRA. The traditional IRA, as you recall, the difference in the beginning is that you get a deduction for adding money into that plan, and then the money grows tax deferred, meaning that you don't pay any taxes throughout the life of the plan, you don't pay any ordinary income, you don't pay any capital gains. The only time you pay taxes is ordinary income when you distribute out of that plan at the end of its life cycle. The Roth IRA primary difference is that you get no deduction for adding money into it, and all of your money grows tax-free, and if you have a qualifying Roth distribution, you pay no tax. So you add money in, you get no deduction, and then when you take money out as a qualified distribution, you pay no tax. It is a very interesting tool and a very powerful one as well, but it certainly isn't the only type of account that you can self-direct. One type of misconception that I've run into in my experience in this field is that people assume that you can only do a certain type of investment. Maybe you can only do a trust or an LLC underneath of a Roth IRA, and it's simply not true. Any of these accounts up here you can certainly self-direct and certainly use with a checkbook control function as well. Now, moving on, the other types of plans that we handle primarily are going to be your employer-based plans. So whether you're a self-employed individual or you are a small business, you want to establish a retirement plan for your employees and yourself so that you can take advantage of much higher contribution limits and also be able to defer taxes via deductibility corporately as well. So with the SEP and simple IRAs, you have the ability to create an IRA that has a component that is contributed in on behalf of your employer. The SEP IRA is the newest iteration of the simple IRA. It is the simplified employer pension plan that is based on the amount of salary that you take from the company. If you take a salary from your company, the company can contribute up to 25% of your base compensation into that plan, not to exceed $53,000. So you create a sizable corporate deduction in this, in that you are contributing on behalf of the company for the employee into the plan, and the employee gets the added benefit of having a sizable contribution into a plan to invest. You can certainly utilize this with a employed individual. You can utilize it with a small company. It scales very nicely, but again, this creates a corporate deduction primarily with only the employee earned income contribution of either $6,500 or $5,500 a year being deductible into that plan. The simple IRA is an older version of the SEP. However, it does have a primary difference in that you are creating corporate and personal deductibility. You have $12,500 of elective deferral compensation that you can add into the plan, meaning the employee says, I'd like to defer X amount, up to $12,500, and put it into the plan, and then a corporate match that is calculable on the actual earnings of the company that can be made in to make up the remainder of the roughly $53,000 of contribution that can go into that plan. The individual 401k is just the scaled down version of the large 401k that we all know and love. It's just basically established that you can take advantage of the elective deferral and corporate profit sharing match into the plan as a small business owner that only has equity owners, or you and your spouse or you individually can add that money into that on the tune of $18,000 a year if you are under the age of 50, and $24,000 a year if you were over the age of 50, with the remaining $35,000 being made up of a profit sharing match that cannot exceed 25% of gross revenues of the company per participant in that plan. Now, the last two that you can self-direct, being the education savings account and the health savings account, are very powerful tools. Primarily, we don't see a lot of education savings being done with self-direction and LLCs and trusts just because the contribution limits are so low. But if you have one of these types of accounts and you're looking for an alternative way to invest it, you can certainly utilize self-direction with an LLC or a trust component to help make the gains that you find acceptable to yourself. And the health savings account, a very interesting plan that with potential changes in healthcare regulation might be seeing a more resurgence, in that you have plans that will inherently be more qualified to the health savings account. If an individual has a high deductible healthcare plan, they can qualify for having $3,400 of personal contribution into the plan for qualifying medical expenses, and $67,500, I believe. Yes, $67,500 for the family plans that they have as well. So if anyone would like to take some notes, here are the actual enumerated versions of what I just covered on the previous slide. And it's a pretty good breaking point for me to get to some of the questions that have been popping up. So let me just flag these and we'll get through some of your questions. Okay, Lynn asks, what is the best way for a single, I believe, member LLC to hold an investment? To hold investment property, no spouse, no children, or single person, no spouse, no children. That is completely subjective. Every person is going to find a different way that is the most advantageous to their own strategy. You can certainly hold it directly under the IRA. You can hold it within an LLC or trust. There is no prescribed method that's going to work best for everyone. And that's the great thing about self-direction, is that just because one person does it another way doesn't mean you have to do the same investment the same way. You can do what works for you, you can do what you know, and you can make it so that the investment is something you inherently understand and can control very well. Okay, Carl asks, I own a rental property outright, no mortgages. Should I quit claim it to my existing LLC or place it in a trust? Well, Carl, if this is a personally owned asset, as in it is not in an IRA currently, you unfortunately would not be able to quit claim it or otherwise convey it into your qualified plan. The IRS covers this in IRC publication 4975, and they consider it self-dealing. So if you have a personally owned asset, you cannot put it into the plan. It has to be a newly acquired asset of the IRA that is purchased in order for it to be a valid investment of the IRA. And that also goes for the LLCs or trusts that you could potentially use underneath of the IRA, because they're considered just an extension of the qualified plan as well. So all the same rules would apply. Okay, Stephen asks, is an IRA administrator required to facilitate a real estate transaction and or monthly rental income receipts? Well, it depends. So in the context of this presentation, We as the administrator don't necessarily need to be involved directly in the actual acquisition of the property. If you use an LLC or a trust that is funded by the IRA is simply holding either the membership interest in the LLC or the grantor beneficiary status of the trust. The trust or the LLC inherently would be what is actually purchasing the real estate, and then in turn would be collecting any sort of rents and income that is derived from that asset. So is the IRA administrator required in order to get to that end? Absolutely. We have to be the ones that are holding title to the trust or LLC. Do we have to be involved in the day-to-day operations of that investment? Not necessarily. You could have us more involved if you don't use an LLC or trust. You could have us much less involved if you do use an LLC or trust. So again, it all depends on what makes the most sense for you and how you'd like to proceed with that. But great question. Okay, Don asked, how long do you have to have a Roth before taking a distribution, or can you take out profit immediately? Okay, great question. We get asked this one a lot. So, as I mentioned before, the Roth distributions are tax-free, completely tax-free if they are qualified. Well, what does qualified mean? So, anytime you add money into a Roth, as on the screen, the $5,500 or $6,500 of earned income contribution, that is always considered basis. You are always based 100% in your contributions to the account. What does basis mean? It means that essentially that is always, money is always yours, and you don't have to worry about timing or aging, anything like that with regards to that. So if I've added money in, if I max my contribution out for 2 years and have $11,000 in there, I can always take that $11,000 out, no problem. However, to be a fully qualified Roth distribution, you do have some rules, and the rules specifically are going to apply to the profit derived from that contribution and to any conversions that you've done. So if you take money from a traditional IRA and put it into a Roth IRA, that's called a conversion, and there's its own set of rules for that. A Roth IRA has to be open for at least 4 years from the date that you initially incepted the account. That doesn't have anything to do with actually funding it. It just has to be open for that amount of time. And you have to be at the age of 59 and a half with the account age for that period of time in order to take out any profits that are derived from the money in the account tax-free. Now, let's say you're over the age of 59 and a half and you did a Roth conversion. Well, the Roth conversion is going to have its own set of rules for being considered fully based, as it does have to age the same amount of time. So unfortunately, you can't just take the net earnings attributable to a Roth conversion immediately out, even if you are of the age of 59 and a half and the account's been open for 4 years. You do have a little bit of looking to do for that. And the ordering rules go that you distribute out of the account in this order. So if you take money out of account and you want to know how it's structured, first you take out your contributions, then you're taking out of the pool of conversions, then you hit your profits. So it's ordered, and you do need to kind of have a good accountant if you are looking at taking out money early to make sure that you were only touching basis or things that aren't going to get you hit with a 10% early withdrawal penalty. But there's a lot of things to look at. So it's one of those things where I tell people, give us a call, we can walk you through it, or if your CPA has questions, we can certainly help them as well. Okay, and last question before we get moving on to the types of investments. Sandra asked, I have an IRA through my union. It is a plan where the companies I work for make deposits. I could, but do not add to it. I also have a 401k that I contribute to as the IRA P, the same as a simple IRA. The short answer to that long question would be potentially. Without kind of looking at an account statement and seeing exactly how you've contributed into that and what the tax qualifications of that plan are, it does sound like something maybe like an antiquated SARSEP or some form of a simple IRA that they're running for you, but I would kind of need to take a look at that more in depth. But it does sound like that it has some sort of basis in a older type of IRA employer plan. Okay. So, investment options. The options to you as the account holder are varied. Now, all of these types of investments can certainly be done underneath of a trust or LLC or directly in the name of the IRA as well, excuse me. The main basis of most of our clients is real estate in one form or another. About 70% of the IRAs that we see invest in real estate in some fashion. Now, this is done in a myriad of different ways. That 70% is made up of people that buy it directly in their IRA. It's made up of people who invest in the lending side of the real estate equation, meaning that they lend someone money and then they hold the actual note and lien on the property. And the other portion of that is people that use either a single member LLC or a grantor beneficiary IRA trust to inherently purchase the property or lend the money. So the way it kind of comes full circle is that people still invest in real estate, and I still consider it mostly a real estate type of investment, even if they do use a single member LLC or trust, as that essentially is just a stand-in for the different type of structure they want to do, with the ultimate investment actually being real estate. Now, these types of accounts can also do futures and forex trading. If you want to trade on a platform that does not offer an IRA, you can either utilize the account directly or the LLC underneath of it to trade in futures or foreign exchange currency, buying private stock, such as private bank stock, or maybe a startup company is looking for funding. You can do that type of investment through an LLC or trust and an IRA and get the great benefits of the future growth of any one of these types of investments. So there aren't a whole lot of things that you can't do with an IRA. There are certain people you cannot transact with, and there are certain things that you cannot buy. The first one being life insurance. Inherently, life insurance is almost always paid out tax-free, and an IRA is not a living, breathing entity, so there's inherently just some structural constraints on the IRA holding a life insurance policy, and they're fairly obvious, and this also goes for LLCs and trusts as well. Now, collectibles is kind of a little bit more of an interesting topic, because the IRS requires that any type of investment with an IRA have a readily determined value. So how do you determine the value of an antique or a piece of artwork, rare coins, an old bottle of wine? Well, inherently is extremely subjective. If someone doesn't like wine, they might just use it for, they might use an incredibly rare bottle of wine for cooking. It doesn't have any sort of intrinsic value that it's rare to them. Things like real estate and mortgage lending, yes, they may have subjectivity to their actual value, but the inherent asset is always going to be worth something in the broad scope of the market. So anything that derives its value from subjectivity or collectability is not allowed within the IRA or subsequently an LLC or trust. However, there are certain types of coins that you can invest in, those being ones that are traded for their bullion content value. So gold, silver, platinum, palladium coins can be purchased as an investment for an IRA, but they do have to meet minimum fineness requirements. And the one thing I will point out on the gold coins is that one of the very popular ones, the South African Cougar Rand, is not an acceptable IRA qualified investment, as it does not meet the minimum purity requirements for that type of investment. All right, we got a couple more questions. Let's get to those. Okay, Don asks, if you have an LLC, I assume that all real estate, including notes and mortgages, need to be in the name of the LLC and not my name. Is that correct? Absolutely. The LLC would be the titled owner of any assets. So if XYZ LLC is owned 100% by your IRA and you want to utilize that for purchasing real estate, the LLC is what goes on the title, goes on the deed and the settlement statement, and the manager of the LLC is whom actually signs all the documents, but it's going to be in the name of that underlying type of investment structure. And also, how do you find reputable clients for lending from an LLC? One of the great things about using a self-directed IRA is that you get to invest in not only what you know, but with who you know. So long as that, and we will on the next on this slide right here, the prohibited person, so long as that you were not dealing with one of these persons, namely someone directly up and down from you in your family tree or your spouse, then you can invest with who you know. So if you have a good network of real estate investors, or you know people that lend out money and you can, inherently, or borrow money and you can inherently trust them, and you know that through your professional network or your investor network, use that experience to help you create the gains that you know and that you know are acceptable to your IRA. So how do you find the reputable people? It's hard to say. I mean, just like you find anyone reputable in the normal course of life, it's, getting out there, getting to know them, sitting down and across the table from them and actually looking them in the eye and seeing if it's someone you actually feel comfortable doing business with. That's the nice thing about this, is that you're not dealing with huge conglomerates that you're just a name and a number with. You're investing with people that you know, and you're investing in a much more personal and hands-on approach. So thank you for the questions. Stephen asked a question, will you cover the fundamental difference between a custodian and an administrator? Sure, I can absolutely cover that. Essentially, in the client's eyes, there are zero. The difference between a company that actually operates as a trust company and is a legal custodian and an administrator, the differences for the end user client are not there. The only difference in a legal sense is that some people operate a model with a trust company as to, wanting to have that full control, and it's a sizable expense to them directly. And some people that operate as an administrator are able to be a little bit more flexible with the fees as they employ a third party custodian in order to do all of the audit and compliance for their company. So with that said, all the types of investments that you can do with an administrator, you can do with a custodian, and all the types of services and investments you're going to do with with a custodian, you can do with an administrator. So, it's a common misconception that there is some, big difference, but from the client's point of view and the regulatory point of view and the safeguards that are in place and the audits and everything like that, there is really nothing that differentiates the two other than just a title. So, with that said, who you can't invest with. You cannot invest with anyone that is a direct lineal descendant or ascendant of you personally. So that's mother, father, son, daughter, or your spouse, or a business entity owned or controlled by any one of the above. So I can't purchase a house and in my IRA or my IRA-owned LLC and have my son or daughter rent it out. That's a common problem that I've run into with people that want to buy a house in a college town. They want to have their children live in it, rent it out while they're in college, and then turn it into a rental afterwards. Well, unfortunately, you can't do that. Also, you cannot buy any sort of personally owned asset from yourself or any one of these individuals. So if your dad has a rental property, you can't purchase that rental property from him. It has to be newly acquired assets, and you can't be doing any sort of cross-the-table transactions with a disqualified person. Here's a few examples of them, and we're not going to spend too much time on this, but you can see how they're enumerated in that with these types of investments, the intent may not be nefarious at all, but it certainly still is prohibited. Now, one of the things that I do like to point out is the big difference between doing this type of investment directly under Advanta and doing it through an LLC or a trust is that the client has to be a lot more diligent with utilizing an LLC or a trust to make sure one of these things doesn't happen. If you do it directly under the IRA and we receive a lease agreement that has the same name, same last name as you on it, we'll ask the question and say, hey, who is this? What's their relationship to you? If you say, hey, it's my brother, I'm renting a house to him, not a problem. But if you say, oh, that's my daughter, I'm going to rent my IRA-owned house to them, we're going to let you know that's not allowable. And so you don't inadvertently back into a prohibited transaction. So utilizing an LLC or a trust does make it so that you have to do a little bit more research and stay a little bit more abreast of all rules and regulations, but it does give you tighter control and more direction to do things the way you want to do them. But just keep in mind that there is a inherent difference in the amount of oversight from the administrator that you have when doing an LLC or a trust. So now what everyone's been signed on for today, the Checkbook Control IRA. So in a custodial administrator account, the administrator retains all the uninvested cash, so any cash that you did not initially invest into the real estate or any cash flow from the property, whether that is mortgage payments, it's principal and interest or interest-only payments, rental payments, the sale proceeds from the sale of an asset or the payoff of a note, all those cash deposits flow directly back into the IRA. That's administered by your self-directed IRA administrator. So that's all well and good, but you also do have to go through us if you want to do any type of investment directly. So if you want to buy real estate, we need to be submitted all the purchase documents in the correct name of the IRA. We will be signing everything on behalf of your IRA. And although it doesn't add inherently much time to anything, some type of assets do really require an immediate type of payment and an immediate approach to actually getting them invested with. So in certain instances, having to do it directly under an administrator doesn't always work. Now, with the checkbook control account, the client that actually should have been on the top of there is the first bullet point. The client personally contains control over the cash using a third-party bank account. So what does that mean? After you've established the LLC or a trust and you've directed Advanta to move the money, you have to have it moved somewhere. We don't hold the cash account for the LLC or the trust. It's wherever you would like to locally bank with, just making sure that the trust or LLC is the titled owner of that business banking account, and you're doing it correctly is the main thing you need to look for in that. But inherently, you have the full leeway to use any bank or financial institution that will correctly hold that account for your IRA-owned LLC or trust. And with that type of control, you have the ability to issue payments directly out of the account and receive deposit income directly to that third-party bank account, where Advanta is only going to be holding the book entry of the LLC or trust under our records for the investment. So now there's key components to both a trust and an LLC with regards to how the investment is actually viewed in our eyes. So with an LLC, you have three main components that we need to see are correctly done or are correctly titled. And we have a question, before I get into the exact points of that, Elizabeth asked, so with a checkbook account and Advanta as the administrator, Advanta still needs to release funds, only in the initial funding of the LLC or trust. So when the account is initially set up, that's when we get the paperwork and the letters of direction investment letters from you to move the money into the entity that you've chosen. After that, it's the prerogative of the trustee of the trust or the manager of the LLC to make sure all the funds are dispersed for the actual investment accordingly. So with an LLC, the main components are going to be the shareholders or the owners of the company. In this case, it would be the IRA is the actual member of the LLC. The day-to-day operations are going to be taken care of by the manager. And in this instance, the manager can potentially be you as the client. So you take full control of the LLC and you name yourself as the manager and then invest the money as you see fit. The operating agreement is the last piece of this puzzle that we need to see, because this details the exact relationship between your IRA as the owner, the management of the company, and establishes the IRA establishes it as the investment of the IRA via the naming of the membership, which has a naming convention that we provide to you to make sure that it's properly titled. So the strategy in a checkbook control IRA is as follows. The entity that the IRA owns is 100% of the LLC. The IRA doesn't inherently own the real estate directly. The IRA owns the LLC that in turn owns the real estate or other type of asset. The checkbook control portion of this is what allows you as the manager or the third party as the manager to directly fund the investments, pay the bills, sign contracts, attend auctions, things like that. So that's where that actual structure is actually maintained. And if the IRA wants to be the manager, they do need to get prior counsel from a CPA or an attorney, as it does get into a little bit of a gray area, which we'll cover in a little bit, as to being able to offer that type of action for your IRA. Excuse me. So the investment strategies that have been presented are fairly basic. Instead of just using your IRA, you are utilizing a trust or an LLC underneath of the IRA in order to accomplish the investment. Now, there is some outstanding case law that has confirmed this actual structure of investment as valid. However, there are some questions that these cases inherently haven't answered that would need to be specifically addressed in order for us to give a definitive answer, especially with regards to managing or being the manager of an IRA-owned LLC. The first most often quoted case is Swanson V Commissioner in 1996. The facts of this case are that the individual Swanson established a newly formed LLC, that is, IRA purchased 100% of the shares of. The LLC inherently then was operating as an import-export business, and the IRS, during the course of an audit, tried to say that it was a personally owned asset, meaning that the LLC was personally owned by Swanson, and that the sale of the shares to his IRA considered a self-dealing prohibited transaction. Well, then they took it to tax court. The tax court determined that because the shares had never been owned by anyone else and that the LLC was newly formed, that this was not constituent of a prohibited transaction. Now, they didn't look at a lot of things in this case. Namely, they didn't look at the fact that his IRA was buying accounts receivable from his other personally owned company, and he was taking a salary from the actual management of the LLC, both which are expressly prohibited. So they didn't look at some things, but they did establish the initial construct of doing this type of investment in an IRA. Furthermore, he actually ended up suing the IRS and receiving all of his legal fees back. So one could say that he might have painted an undue target on his back for future audits, but it is kind of an interesting case to look at. Now, in 2013, we have a tax court memo from an audit under a gentleman named Ellis. Now, Ellis did the exact same type of invest structure where he formed a newly formed LLC. His IRA purchased 100% of the shares in the company, and then he started investing. Well, what he did is when he got audited, the IRS was looking at what was happening, and they said that due to the fact that he was paying himself a salary out of the IRA, or as the manager of the LLC for the IRA-owned LLC, that it was disqualifying. Well, he lost the case, and his whole IRA was disqualified as a prohibited transaction, specifically for the fact that he paid himself a salary. Now, they also looked at it, and they said that the disqualifying event was not him acting as the manager, but only for the fact that he was paying himself a salary for those services. So it gets to a much closer portion of having definitive answers on management. However, it doesn't expressly state that that is certainly allowable. So it's something to get an opinion on from a CPA or an attorney, just to further clarify exactly what you're doing and to make sure that you are staying on the right side of the rules when doing this type of investment. Okay, Richard asked a good question, and this actually kind of ties in really well with this slide, is that can the IRA-owned LLC own a partial interest in a property with the other interest owned personally by the IRA owner but not within their IRA account? The answer is potentially yes. So you can partner with disqualified individuals, meaning yourself personally or your mother, father, son, daughter, or spouse. But what you have to do is you have to partner in what's called a tenant in common purchase, meaning that each individual owns only a certain percentage of the property and nothing more, and is responsible for that portion of the income and expenses for that property as well. So when looking at it from this perspective, you could certainly potentially personally partner with the LLC. The LLC, let's say, would buy 50% undivided interest of the LLC, or the LLC would buy 50% undivided interest of the property. Yourself would buy 50% divided interest in the property, and then all income and expenses are just split along those lines. But just keep in mind, if you are acting as the manager and you also own a personal portion of it, is there some potential for something to get backed into that's not allowable? Certainly. So again, this is where I can't stress enough being very careful with an IRA-owned LLC, because the potential for making a lot of money is there, but also the potential for doing something that you shouldn't is also there as well. And especially when it comes to partnering, it's just something to make sure you take a very subjective look at, and if need be, get the right kind of counsel to make sure that it's being done correctly as well. So great question, Richard. Okay, now key components of a trust. You have the components of the LLC, which are the manager, the member, and the operating agreement. So those are the three main parts that we are going to be looking at as the IRA administrator to make sure it's a valid IRA investment. Now, when it comes to trust, there's a lot of different options out there, much more past just an LLC, because LLCs are fairly well defined amongst the 50 states. You know, there's not going to be a different type of LLC inherently in most states, so it's pretty well established that is the kind of boilerplate model for most of these types of investments. However, with trusts, since they are validated under state law, there are a myriad different types of trusts out there that your IRA can potentially be involved in. You have revocable trusts, meaning that the trust document and underlying language can be changed throughout the life of the trust. Trusts that are set up for individuals with special needs, life insurance trust. It goes on and on. Now, the typical type of trust that we see in an IRA is going to be a grantor beneficiary trust, meaning that the grantor, whom is the initial investor in the trust, is the one who contributes assets to the trust in the way of cash, so your IRA being the grantor, and ultimately who gets the products of the investments, meaning any sort of income or profits, would be the beneficiary. So in this case, the IRA would act as the grantor and the beneficiary on this trust document. Now, a trustee does fall under the category of being a fiduciary, meaning that they are obligated to act in the best interest of the underlying entity in which they are rendering service. You are prohibited from acting as a fiduciary to your IRA and your IRA-owned assets. So in a trust model, you absolutely do have to have a third party that is non-disqualified from yourself personally. So no mother, father, son, daughter, or spouse can be the trustee of your IRA-owned trust, but you could certainly have someone like a brother or another trusted individual that you've known for a long time or invested with act as the trustee for this type of asset. Okay. Now we're going to get into some case studies. And even through the case studies, please keep the questions coming as they typically do help to enrich the presentation. So if you got one, fire it off, just type it into the chat box and I will answer it. So in this case, Joe has a traditional IRA with $150,000 invested in real estate. He wants to get into single-family property, so what does he do? He finds a single-family property to buy. He finds a house that's $100,000 that needs $20,000 of work to get it ready to rent. Now, keep in mind, if your IRA owns a piece of real estate or is looking to buy a piece of real estate, it is going to be liable for its portion of ownership of any sort of expenses. So in this case, if he's looking to use that $150,000 he has in his traditional IRA, buying that $149,000 piece of property that may need work, probably wouldn't work very well. CJ, yes, we will have the recording up on our YouTube channel later on today, so if you can catch the first part that you missed as well. So finding the property for $100,000 that needs $20,000 while leaving a $30,000 buffer in the account is something to look at when doing this type of investment. And that also goes for the LLC because the LLC is the primary investment of the IRA. So keep in mind that the kind of rules and regulations certainly do extend out to the subsequent investments that you do. So he projects the property will net cash flow of about $1,000 a month after repairs. How can he purchase this property? Well, you can purchase it one of two ways. You can either purchase it underneath of the IRA or underneath of a checkbook control. So to illustrate the main differences between these types of investments, let's go through what it takes to do it in an IRA first. The individual completes an IRA application and then transfers either via a direct rollover, custodial transfer into the IRA. After the property is identified, the name of the IRA, which is Advanta IRA, FBO Joe Smith, his account number, is put on the contract. He approves it, and we sign it. Now, this process is inherently done pretty quickly because we have the ability to use DocuSign, so you can digitally approve everything. We can get stuff back to real estate agents, title agents, same day. It's not a problem, but there is just a little bit more of an administrative workflow that you have to go through with this type of model. Now, at closing, all the documents, deed, HUD, title commitment, everything will be approved by Joe prior to us issuing funds out of his account. Once the transaction is complete, we follow up with the title company to make sure that the original recorded deeds is received by us and that we get the original title policy as well. And then subsequently, the cash flows from the investment come directly into the IRA account. We pay all of the expenses that you submit to us for the property, and it goes on in perpetuity until the investment is sold, in which case the sale in reverse is done and the IRA receives all the money from the sale. Now, before we get into actually doing this through the LLC, Sarah has a question. To protect real estate from liability, instead of creating multiple LLCs, would it be equally advisable to create multiple self-directed IRAs, each owning a separate property? Great question. So this is getting into a little bit more of the technical side of things. Essentially what she's asking is that the liability protection that's offered by an LLC typically extends to the LLC itself and potentially any assets that it owns as well, but it insulates the overlying owners and the manager from liability in the event of something happening, whether that's a slip and fall or any other type of action. It is how, in general, that the LLC is structured with regards to its limits of liability. So if you want to hold multiple assets, would it be better to do it under multiple LLCs in one IRA or do multiple IRAs? The answer, unfortunately, is completely subjective. Depending on what kind of advice you've gotten from counsel and how you want to have things structured and a bunch of other different factors, doing multiple IRAs could certainly be a valid strategy for you. There is no regulation as to how many IRAs you can hold. The only kind of limiting factor in that is how much money you can annually contribute into the IRA as an aggregate total, not based on number of accounts. So if I have 5 Roth IRAs, I can't plug $5,500 each into one of them a year. It only goes so far as to $5,500 across all 5. So in reality, it's a really hard question to answer. We have clients that have multiple accounts, each holding a single different IRA-owned property, because just kind of like with the LLC, an IRA is considered a disregarded entity, so any type of asset that it owns is pretty much ancillary in its bucket, if you will, from any other IRA in yourself personally. So looking at it from that perspective, it's hard for me to tell any single person with regards to their personal assets is what's the best idea, but there are certain ways that we can kind of, go over the generalities of it to make sure you are, making the best decision possible. And certainly we have clients that do it many different ways. Don asks, if I wish to partner with an individual who does not have enough money for 50% investment, can I loan him the cash so that both the individual and LLC own the asset? LLC collects loan plus interest at sale. I would say that I would probably, that gets into a big kind of gray area with your IRA receiving a ancillary benefit from another investment that it's already done, because this would be considered 2 different investments. You'd be loaning an individual money that would also inherently be paying back your IRA with money derived from the asset that you jointly own with them. Looking at it, maybe to adjust the percentages, because it doesn't have to be 50-50. You can adjust that to 70-30, 60-40, however it makes the deal work, or potentially maybe just loan the individual the money and have them pay you back principal and interest for the investment that they do. There's a bunch of different strategies to do that, but with particularly that where you are owning a property and also lending the individual money that will be buying the other portion with your IRA, it kind of raises some questions and wouldn't be something that I would feel giving you a 100% yes or no answer on. Getting a legal opinion would be good, but maybe changing the structure might help you get into more of a commonly acceptable transaction format. Okay, and Richard, grab my information at the end of it. If you have questions about specific fees and how that is assessed, I'm more than happy to have that conversation, but that's kind of a long offshoot, because each individual client is going to be different with regard to how an account's built and what potential fees would go on with that. Okay, so getting back into how the actual purchase of an asset works utilizing an LLC versus doing an administrator model, you have the same type of beginning. So you have the client has to open an IRA that is in turn funded either by another 401k or IRA into the actual account. Then instead of going out and identifying a property first, you would need to form an LLC. So you would choose the state that you set the LLC up in, and I would encourage people do whatever is pretty much easiest and cheapest, because the tax advantages and potential privacy advantages from utilizing different states typically aren't as pronounced with IRA-owned assets, because the IRA is already a tax-exempt entity, and if you leave your name off of the vesting of the IRA and the operating agreement, so just having it be Advanta IRA, FBO, IRA number, you do get a pretty high degree of anonymity with it. So some of the perceived benefits of doing ones, the names that come to mind are Nevada and Delaware, may not inherently hold true with doing an IRA-owned LLC Do whatever's easiest. If you want to do one in one of those states, by all means, go for it. Just understand that some of the personal benefits, if you were to do them outside the IRA, can potentially be lost while utilizing an IRA-owned LLC. So just 2 cents on that. So you choose the name for the LLC. All the articles and everything else that needs to be filed with the state need to be done by the client as the manager or another third party. And the article should not mention the IRA. Now, the IRA is going to be listed as 100% owner of the LLC, and the membership, as I mentioned, would be vested in the same naming convention as we went over for a real estate contract previously. Now, the operating agreement would be signed by Advanta, and the manager of the LLC, in this case, Joe, would be signing the operating agreement as well. And now the subsequent LLC operations, whether that's buying real estate, lending mortgages, doing anything else, is going to be taken care of by Joe as the manager of the LLC. All the contracts will be entered into in the name of the LLC. All the closing documents will be signed by the manager of the LLC, etc. Now, cash flow going forward is all deposited to the IRA-owned is deposited to the LLC's bank account, and then all expenses are subsequently paid by the LLC as well. Now, the model of operating it through a trust is almost exactly the same as an LLC, but the inherent difference is the documentation that establishes the actual trust. So this has to be a trust document. Now, many different people can provide these. Trusts are not public records, so you don't need to go through the process of going and getting articles and registering it with a particular state. You just need to make sure that the trust you are establishing is valid under the state that it will be operating in. Now, in this case, the client only needs to approve the trust document. They're not going to be actually signing it because the trust is going to be managed by the trustee, which cannot be the client, as we covered. That would be crossing into being a fiduciary for your IRA, which you cannot do. So the third-party trustee would need to sign the trust document, and the grantor beneficiary, being the IRA, needs to sign that document as well. So in this case, the tax ID number needs to be assigned to the trust, just like you would do for the LLC. The operations are going to be done at the direction of the trustee, not of the manager, as you would in a trust. So it's essentially a lot of just different names for almost the exact type of operations that you're going to be seeing in the end once you get the investment done. Anthony asked, does Advanta help issue and form the trust documents? The answer is in some capacity. We help you in making sure that everything is done correctly per IRA rules and guidelines, but with regards to actually drafting the legal document, we do not provide any provide physical legal service for our clients, meaning that we don't draft operating agreements or LLC agreements. And the reason we do that is to help maintain zero conflict of interest and to help lower the cost for you as a client. If we did get into offering legal advice and drafting legal documents, we would have to charge the clients accordingly. And people that do this as a standalone service or as a kind of templated service typically can help save you money, and we're more than happy to work with whomever you'd like to get that done. Now, the last part of it that is going to be exactly the same whether it's an LLC or a trust is how to remove cash from an LLC or trust when you want to take it personally or move it to another IRA administrator. And this single-handedly is probably the one point that a lot of people get hung up on and we see the most issues with. So if you would like to take a distribution of cash personally from an IRA-owned LLC or trust, the LLC or trust has to distribute the money back to the IRA, so you have to write a check from that entity to Advanta, and then Advanta will deposit that money to the IRA. Then you can subsequently have that money distributed or moved wherever you would like, but we have to be able to do proper reporting if it's a distribution via 1099-R. So if you were to do it just writing a check from the trustee to yourself personally or the LLC manager to yourself personally, it would be considered a prohibited transaction, or potentially, maybe on a little bit less severe side, an improper distribution, but it certainly is not allowable to be done like that. So in order to make sure things are done properly, Advanta first needs to receive the funds from the entity, and then we can distribute them out to you. So we're going to be tying this up a little bit, and here are the few things I'd like you to take away from it. Again, remembering the pros and cons versus using an IRA administrator directly versus utilizing an LLC. One of the big pros of utilizing an administrator versus an LLC or trust is that you're almost always kept at arm's length from your IRA funds. We're holding the funds, you're directing us as where they're to go. You're not going to be signing any document in a legal capacity for your IRA. It's all done at a strictly arm's length transaction. And as I mentioned with regards to potentially renting out a property to your daughter or son, something like that would be pretty easily caught with doing it underneath of Advanta or the IRA administrator. However, you're much less likely to get that kind of friendly oversight if you're doing it through an LLC, as we're not seeing everything that you're doing on a daily basis. And you also have the added benefit of us having clear records of everything that you're doing with the IRA in case you ever need it. Case in point, if you have an issue with a contractor and you need to have all copies of checks and invoices pulled up, we can easily do that for you, as opposed to you would be having to maintain those records personally. Now, some of the downsides, you do potentially run into some higher administrative costs because every time you go to purchase a piece of property or purchase an asset, you're going to be charged for that. There is document review, there's funding, there's everything like that. Whereas with the LLC, you are directly writing the check and making those decisions, and you're not charging yourself a fee. With Advanta, there is some more services that are rendered, so there are some more costs, and you don't have the ability to write checks immediately. If you're doing something like a tax deed auction or other type of property auction, you would need to potentially execute and fund that immediately. And just unfortunately, there's really no administrative process that we can provide to correctly record keep in an immediate sense of fashion. Now, some of the pros and cons of using Checkbook, some of them were kind of covered previously, but you have quick access to funds for auctions and anything like that. You can hold more assets with less fees because you're only going to be charged for the one LLC or trust in the IRA, not for every subsequent asset that is held by that entity. And you have a greater degree of anonymity protection with an LLC or a trust, because instead of maybe Advanta being on the deed of record, you're going to have your LLC, and the LLC is going to offer that wall of protection with regards to privacy, if that's a concern to you. Cons, you're responsible for keeping all the records personally for the LLC or trust, because Advanta, again, will not be seeing everything on a daily basis to record keep and take care of with regards to historical records for you. The lack of oversight can be a potential issue with regards to backing in to a prohibited transaction, and it also can make things a little bit easier to engage in a prohibited transaction, not that anyone particularly is trying to do so, but these simple things can definitely become a little bit easier to do with regard to utilizing an LLC or a trust. So which one's better? Again, that's completely subjective. There is benefits and downsides to both. Most clients choose to have assets held by Advanta and allow us to do the record keeping, but we do have a larger portion, and it certainly has been tending to trend upward with regards to people wanting to do checkbook LLCs and trusts. And remember, we cannot provide counsel or the advice of the investment strategy, so ultimately, whichever one makes the most sense for you is something that you would have to get outside counsel on. That pretty much concludes the portion that is directly related to Checkbook Control LLCs and Trusts. Pretty much hit the ball right on the mark with timing. So now's Q&A. We're going to cover a little bit of how to get started. Again, as we covered previously, you open the account, fund the account, and then from there you decide what type of investments you're going to be looking to do, whether that's an LLC or a trust or anything else. That is completely up to you, and we can certainly help you with that process as well. So if you have any further questions or you want to get some more clarification, I can always schedule a consultation with you for free. We always can do this at any time that's convenient for you, or we can stick around a little bit here. And now it's just open for questions and answers, and here's all my contact information. Thank you very much for joining us today. It's been my pleasure to impart this information. Hopefully everyone found it useful and can go out and make some good decisions and good investments with what we've presented today. It doesn't look like we have anyone particularly asking any questions, so I'm going to go ahead and cut off the recording. Just grab my contact information. I'll be in the office the rest of the day. My cell phone number is the 850 number. The 727 number is the office, so feel free to get a hold of me. Key, just feel free to give me a call. I'm just going to go to lunch here real quick, but I'll be back in the office, probably about after 2, so give me a call whenever it's convenient for you. Thank you.